Enjoy your meeting.
Hey, everybody. Good afternoon. This is
Just a reminder, today's meeting is being recorded.
Thank you for that. And today we're going to quickly review the last couple days in the market. Also try to figure out what the market wants to do over the next few days, and we'll look at the different indexes. And then we're going to try to do something a little different after that. We're going to take a look at an in-depth look at the market letter, and take a look at the CTI, the momentum index, the sentiment index, some of the strength indexes, and what we look at when we formulate our market posture, and how you can use that to get more out of your subscription. We check some of the numbers and analytics that we have on the website, and a lot of people aren't even looking at the market letter, and it's one of the things that we think you should be spending some time on each week, just to get a little more, not a professional look at the market, but a better understanding of what actually is going on inside the market, rather than just what you hear on TV when they're bringing in money managers. They're basically an advertisement for their own firm. So let's get started real quickly, and then at the end we'll open it up to questions. We'll have about 20, 25 minutes of me, and then hopefully the rest of you guys will have some questions. So last week the major averages were lower for a second straight week. The NASDAQ was actually down for a third consecutive week, and as we said on Friday, the market indexes were very oversold going into the weekend. The momentum index had fallen to a -8, which is negative, and the CTI was now a -10, and that's projected to stay there probably for the next 3 weeks. Although with a setup like this, where you're looking for a new low, even though we're projected to stay negative for, like, say, the next 3 or 4 weeks, if things would roll over, say, next week or the week after that, and we see a significant bottom come in, and then we see a higher low the following week, the CTI could then go bullish, because we would reset at that time. Now, we do expect a significant bottom with this, because we have 3 cycles, the A, B, and C, that we'll be resetting when we make a bottom on this round. We'll get into that a little bit later. Sentiment is neutral at +2. We saw a lot of deterioration in the underlying technical indicators last week. Despite today's big spike, hopefully it probably is going to turn out to be an oversold rally. So let's get in here and look at the different indexes real quick. We're going to look at the support and resistance areas. We'll also take a look at the weekly charts, as we can get a little bit better view of what might be going on. Okay, first of all, we have the Dow Jones. As you can see over here, kind of broke a little bit of an uptrend back here a few weeks ago. We also saw it I think it was last Friday, came down at the open and bounced off that 50-day moving average, which is right around 17.8, something like that. What we're looking at over here is we saw the 14-day RSI break down below 30, which is negative. The 30-day stochastic is also trading below 50, so we want to keep an eye on that to see if it continues to trade lower. The pivot point currently on the Dow Jones, and by the pivot point, what you want to look at is where you'll see buying coming in, was 17,808 going into today's trade. So we did break above that, which is one of the reasons why you've seen the Dow kick in more. When traders see the average or index break above the pivot point, that usually means, at least temporarily, they can get a short-term trade out of this. Okay, but support, I don't really expect this to hold. But anyway, first support off of the pivot points on the Dow Jones is going to be 17,449, which is just underneath the 50-day. Second support, which is where our target is going to be down here at 17,117. That also coincides with the 100 and 200-day moving average. So I would imagine this is what you're going to see going forward as far as we kind of roll over here over the next week or two. On the longer term, here's the yearly chart. As you saw over here, we did break above this descending trend line on the Dow. Came down here and, again, we tested that and actually bounced off this descending trend line, which also coincides with the 50-day moving average, which doesn't always happen. But you can also see, again, the different technical indicators going negative. And here's the MACLT, which is more of an intermediate term trend identifier. It has picked up over here. It's right on the line of going bearish on that. So we want to kind of watch that. On the weekly chart, this is going back over 3 years. Again, you saw it just momentarily pop above that descending trend line. We have actually we have a new trending line now. Here's support up here around 17.6 area. The MACD briefly went positive down here, but is now back to turning bearish. You want to keep an eye on that. Of course, we had our W bottom, which was if you measure off of this to here, you'll see we actually reached our target to the upside if you measure that W bottom. So at this stage, you know, it's unlikely to me that this is going to hold. You'll come down. You know, the first average down here is the 50-week moving average down here around 17.4 something. That also is the support one off of the pivot point, and then the 17.1 down here would be where the 200-day moving averages and 100-day moving averages. So watch that for our target. Okay, the S&P 500, you're having a nice rally in that today. Not as much as the Dow. The Dow's outperforming everything today. In fact, you only had the Russell 2000 was up less than 0.5%. It just got a little bit of a pickup now, but it's underperforming. But you'll watch over here with the S&P, the pivot point. Okay, it bounced off the 50-day last week. Actually broke below it briefly, but the 50-day was around 2047. You want to watch that level to the downside. If it breaks below that, we will probably get a break to about the 2012 area, which represents the 200. The pivot point on the S&P was 2070. We're at 2078 right now, so if we close below that 2070 area, that would probably mean that the downturn is still intact. Support 1 comes in at 2029, and the support 2 comes in at 2106, which is 1992, which is right in here, right around the 100-day moving average, and the first resistance is up here at 2106. I want you also to take a look at this, which is starting to look pretty formidable. Here you have a left shoulder, a head, and with today's action, you're probably actually forming a right shoulder. If you would come down here and break this 50-day in this line right here, a target of the high to here to this neckline is also going to target that 1980, 1990 area. So this is where we'd expect this downturn to probably really fight for support. And break below that would be a little rough for the market, to say the least. Okay, here's the 1 year with the S&P. Again, you can see that head and shoulders going over here. This may take a couple of days to form, so I'm not expecting this thing to roll over tomorrow or anything like that, but maybe by the end of the week. We were very oversold. Here's the 30-day stochastic is below 50. Let's see this thing keep on going down. The RSI, on this case, the 14-day RSI actually is below 30. In a bull market, you're not going to see that. Usually, the 40 level will catch it to the downside if you're having a pullback. You want to see it bounce off of 40 and move back. If it breaks below 40 on the 14-day RSI, it generally means that the trend is switching over to bearish also. So keep an eye on that. Here's the weekly chart for this. Again, you can see you had a bounce up here. We did not make it up to the high over here, so you still have a lower high and a lower low. We'll see what happens over here. Stochastic gave on the weekly chart a sell signal over here on it being overbought. So you want to keep an eye on that. MACD down here is still flat, but it looks like a little bit bearish. And you want to keep an eye on these weekly indicators and their signals, because they are actually a little bit stronger signal than what comes off of the daily. So when you get the signal here to sell, that just is confirmation of what you might see on the shorter term, the daily charts. Okay, here's the NASDAQ. We were really oversold on this thing. We had broken below the 50, the 200, and the 100-day. We bounced off of that up on Monday. Get a nice little bounce today to 47.91. So we're up in here at this point, still below the 200-day average. So you want to keep an eye on that to see if it can get any strength in here. Stochastic is still negative. The oscillator, the stochastic oscillator, is still showing a very oversold market. We'll probably get up there to neutral today. MACD is still bearish. The pivot point on the NASDAQ was 48.28, and we are still well below that. So this is where the pivot point is on that. So you have a ways to go on that. First support on the NASDAQ is 46.87, which is right around this area, just below last week's low. And then our target on it was 4,600. That's the second pivot point, or second support off the pivot point, which is what our target is on that area. Now, someone asked had a question during the week that the NASDAQ was at 4,300. What you see at the top on Yahoo Finance and some of these things, they were looking at the NASDAQ 100, which is a different index. So that was just the big cap names. This is the broader NASDAQ. So that's where you want to what we follow on these talks. Okay, here's the weekly NASDAQ. It's not a very good looking chart. Again, you have a lower high and you got a lower low. If you come down here to the 4,600, this is probably almost about a 50% retracement of this whole move. So that still is our target at this stage. You have the stochastic didn't even make it up near where we were before it rolled over. RSI is still negative, and MACD on the long term is still bearish on that. Two other charts real briefly we'll cover, and these are also the weekly. This is the Russell 2000. You kind of bounced over this descending trend line on the weekly chart. Now you're back below it. The pivot point on this is 1125. We are at 1125 currently on this, so this may be about where this stalls out. First support on the Russell 2000 is 1094, which is just above the 200-week moving average. Also, second support would be 1161, which is that's support. Support two would be resistance is 1161, which would be just up here, right around the 100-week moving average. So you want to watch this area for this thing to stall out. And lastly, we're going to look at the transportation index. This almost was starting to get a little bit overbought. It's starting to pull over here, kind of congesting the gains off of that low. MACD down here is flat. Again, you have a lower high, and you've been making lower lows. Pivot point is 78.81. We're at 78.30, so we still have a little ways to go on the upside to get to the pivot point. First support down here you want to watch is 76.14, which is right about this area here. And second support is 73.56, and we'll run into resistance off the pivot points at 81.39, which coincides pretty much with the 100-week moving average. Okay, in conclusion, the market still looks pretty weak. It looks susceptible to lower prices in here. But with zero rates around the globe, you're still getting foreign money coming into our markets. It's still the only game in town. I don't think you could say that earnings were a catalyst to move higher. But right now we're just holding on higher oil at this rate, which if you see oil break below 43 and then below 40, that would be very bearish for the broader market. But as long as we stay around 40, above 44 or so, and that 45 range, I think it can keep a bit in the market with the low interest rates. So keep an eye on that. Just an example of what's going on. Last week when we had that bad jobs report, which probably pushed out a hike in rates maybe for another couple of months, you would have probably seen the market last year rally 200, 300 points on that news just because, but you're not getting the same reaction. So that's something you want to keep in mind when you see the news reports that come out and you get a different reaction from the market. That could be a red flag that things are changing and traders are viewing the bad news as possibly bad news now. That may mean that we could be going into even slower growth. Okay. This week also read something today, actually, that Bank of America's Merrill Lynch branch and also Morgan Stanley, they were noting that to their clients, historically, the market tops out in an election year about 6 months before the election. So that puts that brings May into the picture again. That we should probably see the top of the market in May before we go sideways to possibly down again into the summer. All right, now we're going to switch things up. Again, as we've gotten a lot of questions about the market letter, and for subscribers, if you're not using and looking at the Market Edge weekly, I think it's something that you should take a couple minutes each week and look at because we cover an awful lot of ground on there. And a lot of the stuff that we talk about are what institutional clients that we have and also just floor traders are using. And I want to go over that today just to help you get the most out of your subscription when you're going this. Okay, to define the market letter, first off, if you go up here and click on the markets page, now this is the retail home page or markets page. On the professional markets page, you'll have to see this. You're going to find the market letter over here on the right-hand side. But we've moved this up to the top, this is the daily commentary that we give a little overview each day with some what was strong, maybe a couple stocks that beat earnings, or maybe if any technical events happen, we might mention that. You can read that. It takes about a minute or two each day. But over here is where we have the weekly market letter. It comes out Friday. It's up on the website about, I don't know, maybe 6 o'clock, maybe a little bit after that. So that's where you're going to find it each week to find it. You can also find it over here on the right-hand side, or even up here in the right corner. So, okay, this is what the thing looks like when you go into it. Now, the first several paragraphs up here, what I try to do is we're going to just give a little wrap-up of each day of the week. We're going to include pertinent economic data that may have come out during the week. It's also going to include some stocks that may have had some significant news during the week, maybe an earnings beat or an earnings miss, talks about acquisitions, things like that. Okay, last week we talked about Apple going down a couple of days. It hit a two-year low. Over here on Friday, we had a weaker than expected jobs report. We just make some comments on that, so you'll know some of the economic events that are occurring during the week that may be, that we think anyway, are important to you as an investor that you want to keep in the back of your mind as far as what's going on. After that, we're going to we wrap it up with just basically what the markets did last week, what percentage they were up or down. The next little segment here is the CTI, the Cyclical Trend Index, which we've covered the last couple of weeks. It went to a bearish -10. Our market posture remains bearish. Cycles A and D are bullish currently, while B, C, and E are bearish. We went to a bearish signal on April 8th when the market was trading at 17,576. So it's going against us a little bit. But what the point of this is that we think over the next, while the CTI is bearish, that you're probably looking at a flat to lower market. That's the possibility is that over the last since 1974, except for during the mid 2008, maybe 2010 area, the CTI outperformed the Dow Jones about 2 to 1. So what it basically does is going to keep you invested in the market about anywhere from 50 to 60% of the time, and keep you on the sidelines during periods when we think the market is susceptible to a lower price. Okay, then also in this middle section, we're going to look at the momentum and index and sentiment index, and we're also going to include the strength indexes down here at the bottom. Let me pop into this. Okay, here's the momentum index. Now, the momentum index, what we try to do with this, and this is we bring this into the CTI just to see how much strength or weakness the broader market has. And what this does is the momentum index is going to compare how the other indexes are performing against the Dow Jones. The reason we do that, if the other indexes are all outperforming the Dow, that's a sign that the market is in a really good mindset. We should work our way higher, and you're probably in an accumulation phase of the market, and usually you're going to see that when we're in the throes of a rally or a bullish market. Now, if you see like what's happening right now, where the other indexes are underperforming the Dow, that's a bearish sign. That means that the Dow is kind of what they say, the generals marching without the soldiers, and you want to watch out for that. That means that maybe people are buying in the higher yields, a little bit safer stocks. In this case, when we talked about last week, we talked about the NYSE AD line, advanced decline line, making a new high. We noted that also includes a lot of preferred stocks, a lot of REITs, real estate investment trusts, a lot of closed-end bond funds, a lot of defensive yield-oriented stocks. If you look at the CSO, which is a common stock only, that advanced decline line is far below where we were actually even in December. It's getting good close to where we were in December, but if that, since that's a leading indicator, at this point it's not signaling that we're about to break out to new highs like the cumulative NYSE AD line is. So be careful with that, and that, of course, you can find in the market at a glance. We also look at the number of new 52-week highs versus the number of new 52-week lows in there. We also look at how many stocks are trading above the 50 and 200-day moving average. That helps you gauge whether or not, or helps us gauge whether or not this is a thinly traded rally. Last fall, we kept noting that we only had something like 2 or 3% of the stocks were trading within 2 or 3% of their new highs. That was showing you that you had the FANG stocks, and it was a very thinly traded rally, which was a big red flag for us, and one of the reasons why it helped us flip over to a sell at the 1st of December. Okay, the next one we have over here is the sentiment index. You want to take a look at this. We have a lot of different indicators in here, and I'll actually go over this, all the components that are comprised into this a little bit later at the end of this, so we can go over individually so you can see why they're bullish and bearish. But this looks at a lot of more contrarian indicators, so you can see if everybody's getting too fired up over a move or getting a little bit too bearish. We also include, we take a look at how much money is flowing into the market, especially the U.S. equity funds minus the ETFs. Last week we noted that we had, $962 million of outflows, not much of there, but the week before we had outflows of $4.5 billion. So you did have some, you're having money flowing out. In fact, we've had 1, 2, 3, 4, 5, 6, 7. We've had 7 of the last 8 weeks. We've had money flowing out of the U.S. equity funds. That's something if you're looking to chase a rally or going in to buy, you want to take note of that. Okay, finally over here we have the strength indexes. This is our proprietary measure of whether the different indexes are under accumulation or under distribution. And we check these by, for the Dow, we look at the DIA, which is the Diamond ETF. For the S&P 100, we look at the OEX. Then we look at the QQQ for the NASDAQ 100. Okay, the week ending, let's see, where is it here? The week ending March 28th. Okay, here, yeah, March 24th, I'm sorry. The Dow Jones had fallen from, well, actually, it had fallen from 99% of the stocks were under accumulation the week ending March 24th. Last week, we were down to 20%. So you've had quite a bit of, the people aren't chasing this rally at this, and to move that like that, it's going to be institutions buying or selling. You know, they may still be holding at this stage, but they're not putting new money into the diamonds. We had the OEX fell from 96% on March 24th. We were at 38.2% last week, holding up a little bit better. And the QQQ NASDAQ fell from 93% of the stocks under accumulation the week ending March 24th to just 24.5% last week. Now, they had fallen for 3 straight weeks before the last 2 weeks of April, which they were kind of mixed at that point. Then we had a big slide last week. That's good information so you can gauge the inner strength of a rally. Last fall when we were going in, they topped out, the strength indexes topped out in October, and they fell for 3 weeks, kind of just like this rally, which it looks very similar to the one we had off of the lows before. You had 3 weeks of falling, and you had a bounce to sideways for 2 weeks with the strength indexes, and then we started to roll over again. So the rally from last fall looks very similar to what we just had in here. So keep an eye on that. It's just something I want to take a look at. And finally, we have a summary of this whole letter. And what we do there is we look at the underlying indicators that are concerning us. We might look at the negative and positive divergence that might be going on in the market. We also will look at what sectors are leading, which ones, whether it's defensive sectors are leading the market, maybe more investors are getting more aggressive, what's outperforming. We also might provide targets in there as far as like last week we had the 17.1 for the Dow, 2012 for the S&P, and 4,600 for the NASDAQ. Those numbers actually, this week, they pretty much reflect what the support ranges are based around the pivot points on the S2 levels and the professional traders use to lighten up or add a position. So again, that's the information that you're going to find weekly. It's just to take you a couple minutes to go over it. We try to summarize everything for you. Lastly, we have on this page, we have what were the best ETF categories in the market. And by that, we want to see what's outperformed and underperformed. Last week, the strongest ETFs were specialty real estate. The REITs were up about 3.92% last week. Shorts were up about 2.8%. We also had a little bounce in the utilities. They were up 1.2%. The weakest ETF categories last year were blend, small cap, Europe, the emerging markets, and also especially natural resources. So those are things that you'll find out in this letter. Okay, next what we have just below this section, we have what we call the calendar of technical events. And this is kind of a neat little thing. This is going to, anything technical signal that happened during the week, you can look over here and find out what happened. Now, starting April 22nd, all the technical signals that have happened in the market have been bearish. Now, whether this is a stock or an index, when you're nearing the top and you start seeing the indicators start to flip over and start giving bearish signals, that means you're at close to a top, if not at the top. Just as the other way, if all these were bearish and we were starting at the bottom and we were starting to see the technical events flip over to bullish, you can start thinking about where you want to get into the market, because that means the underlying technical indicators are showing you that there's a bottom near. Next, we give the numbers to watch. If you're looking at the market fell off or it had a little rally, you want to see where resistance and support may come in. So this is an easy way to find it. We also give you the 50 and 200-day moving average, so you can take a look at this and just find areas of support and resistance that are beneficial, and most traders and investors should know where these levels are. Lastly, we're going to give you the industry group rankings. This rally has been so broad-based, we actually got to, I think, 90. We have 91 industry groups. I think a couple of weeks ago, 3 or 4 weeks ago, we had 91 of the industries were either strong or improving. And that's slipped down now to 80 are rated as strong or improving, while 11 are regarded as weak and deteriorating. That's breaking down a little bit more each week. Last week, the strongest were coal, precious metals, steel, and oil field drilling. What was weak last week were retailers. And actually, this is over the last 50-day. I measure these off the 50-day relative strength. I'll show you how you can do that yourself if you want to during the week. The weakest were retailers, apparel, footwear, restaurants, and retailers drug-based. Now, if you're looking for some ideas, if we are looking to go bullish on the market, if you go up to Advanced Tools, click on Industry Group Analysis, go to All Groups, it'll list this alphabetically. But if you click on Relative Strength over here, it'll sort the industry groups by strongest to weakest. So you have over here, here's the precious metals, coal, oil field drilling. They had a little bit of a change over the last day or two. But then if we were looking for some trading ideas, you do this, pull up this relative strength, click on, in this case, oil field drilling. This is going to list the stocks that make up that industry. It's going to list them from strongest to weakest, and then it'll also tell you what our performance is, what the score is, so you can find out where you want to be in here. So if you're looking to buy some oil field drilling stocks, maybe look at this Pioneer Energy, Parker Drilling, High Crush Partners, Forum Energy. This will give you a couple ideas. You can go look at that, then go take a look at the the chart on it and see how we're doing. Here's the group. It had a little bit of a pullback, but it's still pretty strong over here, stronger than some of the other groups. So that basically will give you a place to go where you can find the strongest stocks in the strongest sectors. And now we're going to try to open it up to some questions about whether it's the market letter or if you want to ask about some individual stocks. But I would highly recommend that you just take on Friday night or over the weekend, take 5 minutes to take a look at the market letter. A ton of information in there that can really help you after a couple weeks, give you a feel for what's going on, especially in the internal part of the market. If you watch CNBC, most of these guys that are coming across the on the interviews and all, basically some of them are hedge fund managers, or some of them are they work for Fidelity, or they work for a different money managing fund. Basically, what they're trying to do is they're going to have some place for people to invest, mainly because that's a great advertising for them. They're trying to raise capital for what they want to do. You're not going to get a guy coming on there unless they're shorting stocks for clients. They're not going to come in here and say, I think the market's going to 15,000. This thing looks terrible. There's too many headwinds, because people aren't going to send money into them to invest. So take that with a grain of salt. But if you're aware of what's going on in the market letter, I think you can use that to just back up what you're feeling about the market. Just kind of it'll give you a one spot where you can read up on everything that's going on, and hopefully that'll give you a little bit just a little bit more confidence in what you're doing, whether you're coming out or going into the market. And like I say, to get the most out of your subscription, I think it's important that you take a couple of minutes to look at that. Okay, now we're going to, one last thing here before I told you we were going to look at for questions. At the bottom of the market letter, we list in a table, on the CTI, what was negative, neutral, and all. Here's the momentum index, all these negatives, even though they may be up, or they could still be negative, and that means they're underperforming the Dow, or if it's positive, here the AD line is actually outperforming the Dow to the downside. And then here's what we look at on the sentiment index. If you look at this, we look at the fear and greed index. We give it over a 5-day moving average. Above 75 is going to be bearish. We look at the short interest in the NYSE and the NASDAQ. You can see here it's still bullish because it's been backing off as far as the amount of short positions going on. So they've been clearing out the positions despite what you hear on TV. The short interest has really come down. You also will see the public specialist short ratio. In this case, the public is shorting about 50 times more stock than what the specialists are. That is bullish because, again, generally the specialists are shorting stocks. That means they expect this thing to really get hammered. But when the public is shorting, generally that means that the downside may be a little bit limited. They're not looking for a whole crash. We got the put-call ratio, which is neutral currently. What you want to look on that, and this is on indexes. When the put-call ratio gets above 1.7, that's bullish for the market. That means everybody's too bearish. Between 1 and 1.69 is neutral, and below 1, that's always bullish. That's bearish for the market. That means people are too excited about it, a little bit too bullish. The dividend yield spread has been stuck in bullish ground for a couple of years now. But that's telling you whether it's whether you're going to get a better return with less risk out of bonds or stocks. This thing has to move up to 6 before it goes bearish. Between 5 and 6 is neutral, but below 5 is bullish for the market. It means you're not making any money at all on bonds. And that's why we're down here almost at an all-time low on that. Okay, the next thing you're going to look at, mutual fund liquid asset ratio. This we may be actually taking out at some point, only because with all the ETF hedges and stuff, these guys are hedging their portfolios so much with ETFs and stuff now. It's kind of skewered this, because whether they could still be long and still hedging, which means they're fully invested almost all the time. You used to be able to watch that, and you could see if the mutual fund liquid ratio would get up around maybe 15 or 20. It meant they had too much cash, and that would be bullish for the market because they'd have to get that money to work for it. Also, another contrarian indicators we put up there is the bullish investment advisors and bearish investment advisors. If the bulls get below 40. That's bullish for the market. Right now we're at 40.2. So if we have another downtick, that'll be a bullish signal for the market. Neutral is 55 to 99. That's bullish. I'm sorry. Neutral is 59. No. I'm sorry. My bad. Bearish is 55 to 99. That means that everybody's too bullish on the market. The reason that's a contrarian indicator means that the advisors are pretty much fully invested, which means there's not a lot of money to go into stocks at that point. The bearish is just the opposite. When they're too bearish on the market, that's usually a bottom. That means they're all in cash, and you want to see that go below. Let me see. On the bearish, it's below 20. 21 is bearish. 0 to 20.9 is bearish. 21 to 49 is neutral. And if the bears get above 50, that's bullish for the broader market. Okay, finally, as a bearish plus corrections total, that shows how many people are looking for a crash in the market, and that number 0 to 20 is bearish, 20 to 69 is neutral. If that gets up above 69 to 100, that would be bullish for the market. That means everybody's thrown in the towel. Again, these are contrarian indicators, and like we've talked about a lot of times on these calls, what you're looking for there is for when these things get to a higher level, extended level, and that means that it's gone too far one way or the other. Okay, that's going to be it for. I've talked too much already. It's 35 minutes, but we do have some questions. I'm going to go ahead and close this out and see if we can answer a couple of them real quickly. Let me see if they have to do with stocks. Need a PDF version of market newsletters. Thanks. A PDF version. It's an HTML. I guess you could print it off. I can ask the text if they'll do a PDF on that, but I don't know if it makes any difference. But yeah, you can. We'll see if we can do that. But again, it's just as a web page currently. As you point out, the market letter is bearish. Many equity ETFs remain long zero, Why not change the status to long -1? Well, you got to see a little bit more breaking up on these on some of these short ETFs. Today is going against us. If you had gone, I know the leveraged CTIs, we were about going into last Thursday or Friday, we were about even on. We were making pretty good money on the QQQ. The other ones were the Dow and S&P were about flat, and the S&P the Russell 2000 had really gone against us a little bit. It was off about 12% if you did the leverage ETF, but we're off a little bit right now. Nothing to get excited about. I would say if you take out the highs from a couple of weeks ago, you'd probably want to cover, and maybe the low is in, and because of the rates, you didn't get that sell-off. Okay, our pivot price is the same as support and resistance. We can have a call on the pivot prices. We're adding that to Smart Chart. I was hoping to get that on there first. But pivot prices look at the way they figure, the way traders figure and floor traders figure the pivot prices is they look at the highs and the low. They subtract the difference, and then they add it to the closing price. That will come up with where the resistance and support levels will come. The pivot point itself actually represents when the market gets above that. Generally, floor traders and the quick traders are going to have a positive bias on that market or index or stock. It works on stocks and indexes. So once we fall back below that pivot point, then you're going to start seeing generally if it breaks below with some oomph behind it, you'll start seeing especially the floor traders and traders start to clear out positions and start looking to maybe short the indexes or a stock at that level. So those are kind of important numbers that we talked about today to keep an eye on. Some of them indexes today have gotten above it. Some of them have not. So keep an eye on that. And I will probably do a webinar on that within the next couple of weeks to show you with that how you can figure that out on your own. Okay, we've already gone 40 minutes. I don't see any questions coming in, so I'm going to wrap this up because again, we've gone a little bit too far. So I'm going to pull it off. We hope to see you next week. Again, it's a nice rally today. We'll see how long it lasts. If you start seeing this thing sell off in the afternoons, you don't want to see that as if you're bullish. That would be a sign that the bears or the bulls can't wrestle this away from the bears right now. But we'll see you next week, and thank you for joining me.